Well, all right, you guys. It is January 3rd, late. For some reason, I've made a commitment to myself to try to do something each day to get, a lot of different pieces of a message out. But the bottom line is, as much as I notice on the live calls, sometimes maybe I offend, but I don't mean to. It's just that if we, my head looks terrible, doesn't it? With that, here, let me do this. How's this? I can look like a trained man. Let me see my eyesight's really bad and I can't quite see what you're seeing. I need to get this done. So, yeah. Well, anyway, it is what it is, isn't it? But the number one thing is I really feel alarmed for the world that the United States has had, you and me and your families are heading into over the next decade. And it could start this year. And I think it was, I'm not going to remember the words or I'll remember the concept, I think. I don't remember the character, but in the book War and Peace, was it Pierre? I don't remember. Talked about how sort of with history and with in times, the movements of men and women, the great emotions and trends lead to things like war. But the bottom line is, I really want this year, everyone here, to start thinking about their wealth and their safety and their well-being in things other than the United States dollar. That's probably about the basic thing, and to try to get out of debt. Along those lines, if I can do it, it's a little dark here, and my eyesight, I might not be able to finish this. I think I can. I'm going to try to do it. My favorite investment right now is silver, and it has been so for almost 15 years. I personally invested in silver and then had to use that silver. I did it instead of Bitcoin. I could have bought, coulda, woulda, shoulda, right? But I seriously studied Bitcoin under $1, right around $1. But I bought silver instead. And I actually, at that time, thought silver could move first. And then I'd come back to Bitcoin. Well, I was wrong, of course. But one of the things happening to us in the markets, as some of you and me too, trade some of these stocks, we expect instant returns, instant uplifts, and that's not usually how the market is, as we found out. I do think we could get lucky in the short term with GDC, Finger, and these two SPACs now. Billy Ray pointed out the SPAC for HNRA and the SPAC for Aubrey SPAC, which is CAUD. Those could have nice runs just because there's so little stock in the float. The risk is, of course, the criminals did the same thing to HNRC. So I'm just looking at the chart. I have no specifics. But the risk is they kind of know what they're doing And we still have faith in the system. We still have faith in our government. But I believe that at some point, and some of you know Lou, I think Lou sees this, and I give him great credit. I think Ham has a slightly different vision, where we nail him on one stock and then we go after one, after the other, after the other. But I think, because I remember it, it was a long, long time ago. But I remember when the over-the-counter markets absolutely popped, and everyone was involved in them, and that can come back. You know, I've got to come up with a way of educating. I'm not a professor, but I want you to see some things. So tonight I'm going to try, even though I guess I have to get my eye operation sooner than I thought. I want to read to you an interview, which is old. Let me see when it was. It's a few years ago. I just have to find the date on the book. These interviews are all collected by Chris Marcus in his book, The Big Silver Short. And unfortunately, there's no date anywhere on this book. Maybe on the price tag. No, there's no date. But I'd say this is probably about 3 or 4 years old. So this is an interview with David Morgan, whose service I subscribe to. I haven't had a chance to use it recently because I've been tied up, in this, let's call it what it is, a fight. But he's the founder of the Morgan Report. And each of these gentlemen, and there's a couple of women, but mostly gentlemen in the precious metals area, have their own unique personality, but also their unique view on what's coming. So, okay, here's a date. This interview was recorded on January 16th, 2019, and the closing price of silver that day was $15.53. And silver's around $23, $24 now. You can't buy it for that price. There's a premium. Frustrates me. I wanted to buy silver. It got as low as 10 and 15. But okay, I'm going to just say a couple things about David Morgan. If you've been investing in silver, there's a good chance you're already familiar with David Morgan, who is known as the Silver Guru. He may know more about the history of silver than anyone out there. David's books and interviews were always a nice counterbalance in terms of providing the fundamentals and the supply and demand profile. And he's a trader himself. I say this to point out that David not only uses his incredible historical knowledge to talk about the past, but he also successfully applies it to one of the most challenging markets to trade, which is silver. Additionally, and this I agree with, I've never met him, but I've studied him, read his books, followed him for years. I agree with this. He is just a genuinely good man. So it's great to have him involved with this project. Okay, so the book is called The Big Silver Short by Chris Marcus. And this is the interview from January 16th, 2019. Silver is still cheap, even though it's up about $10 from when this interview, well, $7-8 from when this interview was given. So Chris starts, and then it's David. So it's Chris Marcus and David Morgan. I'll just use their first names as we go. So Chris says, in our next chapter of The Big Silver Short, we will be digging into the incredible dynamics and history of the silver market that most are unaware of, yet would probably be well served to know about. So I'm excited to be with one of the world's leading silver experts, whose research I've been following for years. After all, how could we have a book about silver without inviting David Morgan of the Morgan Report? I'd go along with that. What you'll find is everyone talks about gold, and even when they talk about silver, it's as a stepchild to gold. And it's when they're mining for gold, they also find silver. There's very few companies that focus solely on silver, and I know one that I really like, although it's in the clutches of toxic financing. And people as smart as Eric Sprott get involved in this toxic financing. It's just, and he's a billionaire. I mean, I don't know if he gets involved in it personally, of course. I mean, the companies that he invests in have it. And when will Congress realize that self-regulating regulators, SROs, just can't, they're not sufficient to protect investors and CEOs and the very United States way of life. So anyway, this will have a rhythm. How do I do it? The first person speaking is Chris. David, great to have you here today. How are you doing, my friend? David, doing all right, Chris. Thanks for inviting me. So I guess it's just gonna, I don't know how, I'll just tell you, change each time. You've been studying this for quite a while now, but can you tell us what led you initially to become interested in silver? David, well, as you know from my book, Get the Skinny on Silver Investing, which I have and read somewhere, I was 11 years old when the coin was changed from 90% silver to the Johnson slug. That kind of piqued my interest, and I became fascinated with money. Started doing my own research, and I'm going to skip a bunch of this just to make sure this video isn't long. We're already at 13 minutes, which is my fault. But really, I was pretty much a gold bug. Yet after the peak of gold on January 21st, 1980, rabbit is rich, I saw how silver had outperformed gold and how the Hunt brothers had primarily gotten into the silver market. So I started looking into silver. And he says some books that he started reading. I haven't read these. Silver Profits in the 70s, Silver Profits in the 80s, the coming currency collapse and what you can do about it. That was in 1980, 70s, 80s. So this has been a long-running story, which is why I was always skeptical at the people that got caught up in it. And I put it down for a while when Bitcoin raced ahead, because that was the pressure valve, and precious metals were able to be manipulated in a stable way over at least the last decade. Okay. All right, let's go to the serious question. So can you give us an overview of the supply and demand as you see it? Now, this is 3 or 4 years ago, but it hasn't changed. We hear from the Silver Institute that there's a yearly deficit. And this yearly deficit started sometime over the last 15 years. There used to be a surplus of silver in the United States. I don't know where they stored it. I can't remember. It came from the gold mining, and it was saved for, I think, military uses. But it was always there. So that supply kept pressure on the market. That's gone now. And now it's paper silver that keeps the price down. To me, silver has more interest because it really does have uses. Gold has some uses, but silver's in everything from medicine to your computers to, photography, although it's less so now, and your phones. When it gets used, it's removed from the world's supply. Gold, on the other hand, as people accumulate it, it doesn't get thrown into the various dumps and earth deposits where we throw our trash like silver can do. Silver's in weapons, gets blown up and gone. So anyway, that's silver as I remember it. Once the surplus was gone, every year the mints, particularly all over the world, but particularly here in the United States, run out of silver sometime during the year to print coins with. But for people who are hearing this for the first time, what could you say about the supply and demand profile? Well, this is David Morgan. Well, looking at the supply and demand overall, if you go from 1990 to 2006, demand was so much greater than supply that we were in a deficit for over 15 straight years of about 100 million ounces of silver on an annual basis. So, and here, I didn't know he was going to say this. So, we went from an above ground stockpile of 2 billion ounces down to 500 million ounces above ground in a stockpile during those 15 years. Then in the early 2000s, the China boom started to take place, and there was this huge move into more mining activity across the board. Copper, lead, zinc, silver, gold, and everything you could imagine was being dug up to fuel what you might call the Industrial Revolution of China. So the mining production increased substantially from 2006 to present day. And the above ground inventory went from 500 million ounces to what it is now, which is about 2.5 billion ounces. I don't know if that's true in the United States, but let's follow his thought. We basically hit the bottom on the amount of supply when it went from 2 billion ounces to 500 million, and then it went from 500 million to 2.5 billion. That's the stockpiles. With the latter move taking place from 2006 to 2018, so 12 years. Now, let's look at the supply and demand as far as the industrial breakdown. If you go back about 15 or 20 years, the demand from industry was 35% of the total silver market. And the market was about 550 million ounces of total production per year, I'm sure is what he means. Now we're at about 850 to 900 million ounces of total mine production. And when you add in recycling, That makes it about 1 billion ounces. Yet, the industrial demand is 50 to 60% of that figure, depending on which study you use. The CPMs, I don't know what that stands for, I'll think of it, or the Silver Institutes. And what that means is industrial demand has increased substantially over the last 20 years. That's why I think now's the time to start accumulating silver. The supply and demand balances are coming in our favor. Yet, the markets always move at the margin. Hear that? Markets always move at the margin. That's true in everything we trade. And the margin is investment demand and monetary demand. Because if the total supply of silver is X and 60% of X fills all the demand from industry, that remaining 40% is taken somewhere. And where is that? Well, it's in silverware, but not so much photography anymore, as that's minuscule these days. There's jewelry and silverware, and the rest is investment demand. So outside of industrial, jewelry, silverware, and investment demand. I think there's military too. When the Silver Institute does their survey, the way that they categorize the deficit is above ground stockpiles being added to for investment purposes. I have no objection to their accounting for it in that way, but I'll just call it a structural deficit, where you see the above ground stockpile deplete, and we're not having a structural deficit at this time, or at least over the last 12 years. And this is Chris asking the question. Yes, I know for a while that there was a large government stockpile. That's what I was talking about, which you mentioned had been drawn down. Are we at the point now where there's actually less above ground silver than gold? David, first of all, there's more silver than gold below ground. No ifs, ands, or buts about it. I can't remember the ratio, 6 to 1. That might be natural gas to oil. 6 to 1 or 10 to 1, something like that. Anyway, let's find out what he says. If you look at it from an investment-only standpoint, though, which I do, you have 5 billion ounces of gold in investment form and only about 2.5 billion ounces of silver in investment form. So if you look at it from an investment-only standpoint, you have 5 billion ounces of gold in investment form and only about 2.5 billion ounces of silver in investment form. So from that category, there's less silver than gold. But as far as what's below ground, there's more silver than gold. The question was about above ground silver. Anyway, David, this is Chris asking. People have been talking quite a bit recently about the gold to silver ratio. Good. This is what I want you to think about. It got as high as 120 to 1. 120 to 1. And I hear estimates of the ratio of gold to silver in the Earth's crust range anywhere from 8 to 17 to 1. Do you have any thoughts on why it's so high and what the fair range may be and how you see that playing out? Well, the gold to silver ratio gets a lot of criticism, but it tells you one thing. It tells you which metal is performing better. When the ratio is dropping, it says silver is outperforming gold. And if it is rising, gold is outperforming silver. So 85 to 1 is extreme, And I think it's going to come down from that level. It was 120 to 1. I don't know where it is now. It might be close to 100. No, it's not. I'd say probably this 85 is where it is. What is the proper ratio? David asks. I don't know. But Franklin Saunders did a great study in his book, Silver Bonanza. He points out that if you look at the gold to silver ratio over centuries, if every century was 1 foot in length on a scroll and you rolled it out, it would be 35 feet long, and it would only be in the last foot of that scroll, the last century of 3,500 years, where the gold to silver ratio got above 16 to 1. That's the number I was trying to remember, 16 to 1. That's the historical number. The United States Geological Survey says that the natural ratio right now is 9 to 1. 9 to 1. And we'll take them at their word. But no one knows the exact number. It stayed at the natural ratio, and then during the global crisis at the time, Sir Isaac Newton put England back on the gold standard and basically mandated a 15.5 to 1 monetary ratio, silver to gold. I call that the classic ratio, which held for hundreds of years. So when gold and silver served as monetary assets, money, they held those two ratios for centuries. Once it was demonetized, then we saw the big bifurcation with silver not being a monetary asset and gold pretty much remaining a monetary asset. We saw 100 to 1 in the ratio a couple of times, 80 to 1, and then moving back down to 16 to 1 when the Hunt brothers. That's what I'm predicting, and I'm no genius. But right now the ratio is expanded. I think you're going to go back to 16 to 1 or 9 to 1. I actually predict uno per uno. Is that Spanish? I predict 1 for 1. Hopefully it takes a while to get there because we want to accumulate it. So the ratio is important. And I think, David Morgan says, I think that silver will outperform gold in this last leg up in the bull market. I think it will outperform by at least 2 to 1. I expect the gold to silver ratio to go from 80 or 85 down to 40 as a minimum. I think going to 20 to 1 is possible. He's a lot smarter than I am. The classic ratio is possible. And even going to the natural ratio is possible. So the classic ratio is 15.5 to 1. The natural ratio right now is 9 to 1. And then he says, although I don't see it going to par, certainly not in his lifetime. Well, we'll see. But it's important. In fact, trading the ratio is a great thing to do. I know a couple of people that are running funds which basically offer interest on their gold. And the way you do that is to sell gold for silver when the ratio is appropriate, like right now. Then when the ratio drops to 50 to 1, you sell the silver for gold and replenish your gold stocks. It's not that hard to do. That's an interesting idea. Okay, so he asked this question. Obviously, there's a lot of paper leverage in the market, in other words, manipulation, which often distorts things. But if the metals were trading freely, what do you think would be a fair value of gold and silver? And this is 2019, but everything's been steady on for a while. So I don't think these numbers really have really changed that much. But we'll follow up with other interviews. Maybe I can get him to come on and talk to you. David says, that's a pretty interesting question. There's a paper of mine that you can look up called Engineering the Price of Gold. If you just take M1 is the measurement of money supply at its most basic. I don't know if any of you remember checking accounts, but I think it was basically checking accounts, savings accounts, and maybe currency in circulation, a measure of M1. If you take M1 is a figure calculated by the Fed, which represents one measurement of the money supply, and divide it by the amount of the gold the Treasury says we have. If you do that math, it came out to $2,500 an ounce, and this was 5 years ago. Well, 2019. If you did that same arithmetic problem in 1980, the full cover of M1 money supply, gold would have been $400. But we know the price of gold in 1980 hit $850. John Updike, rabbit is rich. So David goes on. I mentioned in the article that in times of panic buying, you could see it overshoot the theoretical cover. In other words, to fully cover every paper dollar out there, M1 only, not credit, but just physical money, you only needed $400 gold in 1980, but it went to $850. In using those metrics again, when I said it would be 2,500, and we're not that far from that now, 2,500, there's no reason to think it couldn't overshoot that number again. If you do the arithmetic today, it comes out to over $10,000 an ounce. $10,000 an ounce for gold. That is irrefutable. Just take the amount of M1 and the 265 million ounces the Treasury has and do the division. So now you have over 10,000 gold. So what happens to silver? Well, is silver worth 1/10 the price of gold? Well, then it's $1,000 an ounce. Is it worth 1/20th the price of gold? Then it's worth $500. Is it worth 1/40th? Well, then it's worth $250 an ounce. Silver right now is $23. I'm telling you, silver has upside that's every bit as good as any of these stocks we're fumbling with. Once gold takes off, people will follow the leader. The momentum will take off. And people who can't afford gold, as it is moving through 2,500, 3,000, 3,500, then they'll move to silver. There's a lot of people out there with 3,500 and not 3.5 million who will move into the silver market. And I think the ratio will squeeze. Whether 10-to-1 is extreme or not, I don't know. People ask me if I think silver will reach par with gold. William, I think it will. David says, I don't rule it out, but I certainly don't see that, although I've been surprised with moves in the silver market throughout my lifetime. I called a spike low many years ago. It's typical of silver to spike low, by the way. I remember the price was $18, and that spike was the low for 14 solid months. It was 1813. I was absolutely 100% correct until I was wrong. That's the stuff you have to put up with in the silver market. That's when I coined the phrase on the Jim Palapla show. Silver will either scare you or wear you out, unquote. I feel like that with these manipulated stocks that we're in. Okay, so here's Chris asking. You pointed out the relatively small size of the silver market. Part of why it moves so much when it moves is that size as compared to the stock market or the bond market. The silver market is relatively small, so it doesn't take a lot of money to move it. One of the things, this is Chris talking, which has left me feeling more comfortable with gold and silver as opposed to other investments, and this is where I'm coming from now. I'm kind of trying to force feed you. That's why I'm up late tonight after I got worn out by that live call earlier today. My weakness, not yours. That's my weakness. Chris got more comfortable with gold and silver as opposed to any other investment, is that until debt loads, money printing burdens, and quantitative easing packages are somewhat resolved, it's hard to see a way out in which gold and silver aren't going to do extremely well. David says, I agree. I've been looking at this for over 40 years, and monetary history teaches us a great deal. Even in my lifetime, this is David Morgan, I saw the bull market from the 70s through 1980, and you see what's happening in a way we cannot refute. China, Russia, and India have been accumulating so much gold. Even though the powers that be might talk about it being out of fashion, as Keynes call it, a barbaric relic, or that gold's just tradition, or any of that nonsense, the fact remains that they continue to buy it and keep it. That's China, Russia, and India. We don't buy it in the West, but that could change. Sentiment can change on a dime, as Jack McCarthy used to say. Sentiment can change on a dime. Plus, we know in modern times that the gold market moves inversely to the stock market. If stocks start to fall further, which I believe they will, you'll see a much higher gold price. So I wouldn't give up on gold, but I also want to add for my own peace of mind. I've never ever said, go all in with gold and silver. In fact, it's in writing, and I don't do it every interview, but my 10 rules of silver investing stand the test of time. And I'll get those to you. I have them. And rule 10 is that too much of a good thing is too much of a good thing. 10% allocation is probably enough for most people. I did up that to 20%, but the most you should have in these markets is probably 20% as a hedge. There are people who choose to do more, but I'm not advocating that because a lot of people get excited during the upward momentum. It sounds just like our stocks. Same psychology. So Chris asks, would love to hear your thoughts on what happened in 2011. That's when I was thinking of buying Bitcoin, to my memory. There was a big run up to $49, and I got all hyped up in it. And then the price came down quickly. What's your take on that move? David says, that's where I lost a lot of subscribers. I called the top. David called the top in 2011 about 2 days early, which is perfect because you want to sell into strength. And I can show you my trades. At the time, silver had a very big base at about $19 an ounce. It had what's called a channel formation, which is basically a flat line. A channel formation makes things easy to trade. If it breaks through the channel, you go long, and if it breaks down through the channel, you go short. That sounds like a lot of our stocks. All right, I'm not gonna read. I'm not going to read this all out. I'm skipping a lot of this answer because I don't want to bore you. I mean, we can always talk about it later. Okay, so it ran up and then it broke down through 26, and that was the psychological level of silver being a good investment at $26. That's 12 years ago, 13 years ago. Really, from that point of view until now, it's been broken. There have been silver bulls like me who have traded short term or bought certain stocks. But in general, that's the story of silver. So it had a run in 2011. It's pulled back, and it's just been basically dead money. Yeah, I mean, you could trade it for over a decade, which surprises the heck out of me. But I'm sensing that we're going to have a new push above 26 and a lot higher. Okay, this is the question. We've seen throughout history over and over again that there's some break point when eventually people realize there's a lot of these paper currency units, but just the exact same amount of metal. So are we headed toward an eventual break point where people lose faith in the dollar and rush into gold and silver, even more so than 2011 or in 1980? David answers, well, yeah, that possibility exists. In my younger days, I thought along the same lines. But so far, the system has held. I'm not going to read all the examples because this is 42 minutes. I'll do it on a different call or maybe when we're live. I appreciate that you pointed out for everyone who are a bit critical of precious metals that gold was $250 in 2001, and it's up 5-fold since then. It's actually up now 10-fold, well, 8-fold. And then he talks about paper contracts, which is how they manipulate the silver market. And the questioner asks that he's heard there's 500 paper claims, 500 paper ounces to each physical ounce. Does that sound like our markets that we're trading in? Are these reports accurate? How does it unfold? David's answer, yes, they are accurate. We have no idea what the over-the-counter derivatives are. That's the same as in our stocks we're trading. And that's a result of the Graham-Bliley-Leach Act, which Rubin promoted to Bill Clinton, and Bill Clinton signed and trumpeted because markets can regulate themselves. Well, even markets have limits. Okay, so David says we are just looking at the London Metals Exchange, the COMEX, and all the derivatives markets which are reportable. So that's just the reportable numbers. That's just the reportable numbers that come to 500 paper ounces of silver to 1 physical ounce of silver. But if you consider all the bank-to-bank, peer-to-peer, mine-to-mine, mine-to-corporation, corporation-to-mine, banker-to-corporation transactions, with all of these hypothecations and rehypothecations, that means you could probably not only have 500 to 1, but you could have 1,000 to 1. It's the same criminality. This, well, leaving the criminal part out, this is, David says, this is extremely vulnerable if, and only if, the physical demand exceeds the ability to meet the physical supply. So that's, well, let's read more than he says. Let me explain that a little more. As long as anyone standing for delivery gets it within a reasonable amount of time, they can have that much leverage and get away with it. But as soon as that doesn't happen, delivery in a reasonable amount of time, where someone like a jewelry store or the US Mint needs it, then there's a problem. People will call me up and say they had to wait for silver from the mint, but that's not really true. That's happened a couple of times, but it's been a very small wait. Most of the wait time actually has to do with changing the date on the coins. Don't get me started down that rabbit hole. He's a very conservative guy. That's why I like to follow him. But basically, the more phony paper, silver, gold, soybeans, wheats, or whatnot, and we're in the whatnot area, that exists relative to physical supply, the more vulnerable you become to a problem. Why do we let this go on? It really accelerated after Bill Clinton. Back then, we thought Reagan was the one that was going to open up Wall Street to the banksters. But it was Bill Clinton and everybody since. Everything is a trade. Everything's a bet. Do you see that fly crawling up that window? I bet it goes all the way to the top in 30 seconds without flying. You see those 2 red cars? I bet the old one pulls away from the red light sooner. Let's make a bet. Everything's a bet. So anyway, the more phony paper, the more vulnerable you become to the problem. That is why COMEX has set it up that you're only allowed to take delivery of 1,500 contracts per month. You're only allowed to take 7.5 million ounces of silver off the exchange in any delivery month. To be able to take more than that would be breaking their rules. Everything that's set up in the futures exchange is for the short, not for the long. Do you hear that? Everything on this exchange is set up for the short, not the long. That's what's come to our securities markets. Everything from Adina Friedman down to Gary Gensler, down to Robert Cook, down to Jessica Hopper, everything is set up for the shorts. Everything. And I know I get upset. Don't rant, don't rage. It makes me upset. I'm going to read that again. Everything that it's set up in the future exchange is for the short, not for the long. They protect that for a lot of reasons, mostly because it's a boys' club that's partial to taking on trades that most people would think are foolish. That's true. I mean, who wants to be short silver when it's $5 an ounce? They did it. Who wants to be short silver now at $14.50? Well, now it's $23. That's a good price to get it out of the ground at. People aren't going to understand this, but I'll say it anyway. If you go to the TMS, the true Austrian money supply, which us Austrians, he's talking to economists, the Austrian School of Economics, you'll see silver is actually cheaper today at $15 an ounce than it was at $5 an ounce. Well, wait a minute, David. 15 is a bigger number than 5. But when silver was 22 cents in the Great Depression, on an inflation-adjusted basis, that was more expensive than when Buffett bought it at $5 an ounce in the 1990s. He was buying it cheaper then during the Great Depression, even though in nominal terms, $5 is a much bigger number than 22 cents. People don't talk about inflation enough, yet begin to understand it. But if you use inflation-adjusted numbers, silver is cheaper today than it was during the Great Depression or when Buffett bought it for $5. Because there's been so much printing since silver was at $5 in the early 2000s, that's a massive amount of paper that's been pushed onto the public corporations and the banking system and everywhere else. Silver hasn't caught up with it yet, but I think it will, according to David Morgan. Sounds like the main thing in terms of forcing a potential short squeeze, Chris asks. Yes, it could be that, David says, or if industry doesn't get what they need. But the problem with the way the system is set up is that with all of those contracts, paper contracts, you're forced to take cash. You can't ask for silver. And they can print an infinite amount of cash, as we certainly know. It sounds so similar to our stock markets where the criminals can print an infinite amount of shares. David goes on to say, with some of these crazy over-the-counter derivatives contracts, some are legit, some are true hedges, and some are good business practices. I don't want to paint a broad brush by saying it's all evil. It's not all evil. But with these contracts, there would be settlement in physical. And a lot of times there is a weasel clause that during a force majeure, an international trade dispute, bank closure, you're required to take cash. From a legal standpoint, that's probably smart, just depending on what side of the contract you're on. And then Chris says, it's going to be fascinating to see how this unfolds because the debt loads aren't getting any smaller. Do you know we just went to 34 trillion? 34 trillion in our debt, 34 trillion. Good thing we didn't re-elect the previous guy. And we got this fiscal genius in. This is interesting. This is in 2019. The Fed sounds like they're getting ready to start the printing presses again. And it seems like a lot of folks aren't even pricing in a single hike in 2019. That's why I couldn't believe that banks like SVB didn't even think there would be any hikes in rates. So it will be interesting to see what happens if rates go lower. He actually called for silver to be basically flat. Okay, so that's it. I'm not sure you learned a lot, but that's an interview with Chris Marcus in his compilation of interviews with David Morgan of the Morgan Report, which you can go online to. And the book's name is The Big Silver Short. It's been 55 minutes, so I'm going to end it there. I thank you for listening. I'll try to get these in shorter form, but it's one of my New Year's resolutions is to try to get all of us thinking about precious metals and other things, oil and gas and other investments. So thank you. We'll catch up tomorrow, and peace.